Getting money into your super fund. The government has limited how much you can get into a superannuation fund. They do that I guess they want to control the amount of tax benefit they're giving away, and certainly they need all the revenue they can get at the moment, and they do that in two ways. Caps, how much you can get in, and age, when you can get it in and when you have to stop getting it in. Going to drive you nuts with jargon. As soon as you get into superannuation funds, you start picking up these terms, and try not to use them where I can, but unfortunately you can't avoid it. And so things like concessional contributions, all that means is that someone's got a tax deduction, either your employer or yourself. $25,000 per person per year at the moment. As of the 1st of July, that's intended to go to $35,000. We'll obviously have to wait on bills getting through Parliament in the next couple of weeks for that to actually take place. One thing to be careful of, those caps are across all super funds. So you can't put $25,000 per person into your own fund and then sneak off and stick $25,000 into AMP to get your $50,000 that you wanted to get in. No, they're all amalgamated together, and it's $25,000 in total per person. Non-concessional, all that means is that no one's getting a tax deduction for it. $150,000 per person per year. So it's a voluntary contribution. There's no tax benefit in it. You've just decided you've got some spare cash, or you're doing some estate planning, you just want to build your super fund balance up. So $150,000 per person, but if you're under 65 years of age, you can cheat and bring forward 2 more years worth into 1 year. So you can get $450,000 in, but you can't do anything for the next 2 years after that. So it is a way of getting a larger lump sum in a hurry if you're looking for a larger superannuation balance. You just need to be mindful of that. If you've exceeded the 150, you've chewed into some of next year's. If you've used 450, you've used 3 years worth, and you'll have to sit tight for a while before you can do anything further. Again, that non-concessional contribution cap is across all superannuation funds, so you can't do the same thing in multiple funds. There's a third way of contributing money or assets, and that's through small business entity capital gains tax concessions, and they're really complex, so that line's about all you're going to see on that. But basically, if you're running a small farm or a small business, sell it in some form or another, you can put the money into superannuation, tax-free. It'll always be tax-free when it comes back out again. But there are some complex rules, so we won't get too bogged down on that tonight. Age limits, I've mentioned those. That's the other way that the government stops money getting into superannuation. No problems at all up until age 65. Pretty much those contribution caps on the other side of the screen are all you need to think about. Once you turn 65, you need to pass a work test. So that's 40 hours in a 30-day period, sometime in that financial year that you want to make the contribution. So if you're 66 years old and retired, you won't be able to get any money in. You need to go off and get a job for a little bit to get that cash into the super fund. Currently, once you're 75, bad luck, no more contributions are allowed. Those age limits will change as the government lifts the Centrelink age limits. So they've already flagged that the age for receiving Centrelink age pension will move to 67. I think it's intended, no legislation as yet, but it should move with it. So 65 will become 67, and no idea what they'll do beyond that. But one form of getting money into superannuation that's fairly popular at the moment is called salary sacrifice. All it means is that you give up some of your income that you're earning to have it put directly into a superannuation fund. So what you're doing is you're reducing your personal income, and therefore your personal income tax, at the expense of superannuation contributions. So you're building your superannuation balance a little more quickly than just having the employer put in the 9%, or 9.25 as it will be shortly. Same rules apply in terms of concessional contribution caps. You still can only have 25,000 go in, and that must include what your employer is already putting in for you. So if you have had $5,000 of employer contributions go in during the course of the 12-month period, you can only put $20,000 of salary sacrifice in that same 12-month period. It does tend to be a bit of a trap because you don't really know what's going on during the year, so it's something you've got to keep a pretty close eye on if you do go down the salary sacrifice path. I'm going to talk about retirement, transition to retirement pensions a bit later, so I'm mentioning it there, and it's off. Salary sacrifice and transition to retirement pensions often go hand in hand, but I'll come back to that with an example later on in the session. Why would you do this? Yeah, look, you're shifting your income from being taxed in your own name at potentially a higher tax rate down to the super fund tax rate of just 15%. So if you're lucky enough to be earning a large amount of money and being taxed at 45% personally, there's a 30% tax saving to be had by shuffling it across into the super fund. The other way of getting money into your super fund is simply taking money that's already in a super fund and shifting it across into your self-managed super fund. There's no caps with this. If it's in super already, you've met all the rules about getting it in, so you can shift it around as much as you like. Most funds will charge a fee for it to some extent. Usually it's just an administration fee. So if you happen to be with Australian Super or Prime or one of those industry funds, it might be 50 or 60 bucks to roll your money out and shift it across to your self-managed super fund, or indeed another industry fund or retail fund. The government some time ago introduced superannuation choice, so there's no restrictions. You can pretty much move your money where you want to, other than government employees, which come up against the fact that the government only wants to pay it into a certain superannuation fund. And there's a couple of potential traps there that you need to be wary of. If you happen to be a government employee with government superannuation money, it doesn't roll across tax-free necessarily. There's potentially some tax that you will pay at that particular point. And the other one is you need to be wary of losing life insurance that may be built into your existing superannuation. So if you do have money with Australian Super, when you roll that money out, Australian Super will cancel your life insurance. So wherever you move it to, you may need to replicate that insurance there to make sure you're still covered. So don't just roll it over willy-nilly. Ask and get some advice on it before you do it. Sometimes, particularly once you get to 50, like some people, myself, getting life insurance isn't as easy or as cheap as it once was when you're a lot younger. So you might be better off rolling over part of your money and leaving a little bit behind just to keep the insurance alive and ticking along. So we've got the money in three ways: contributions, rollovers, the capital gains tax exemptions. What do you do with it once it's there? You need to invest it. There's not that many things that you cannot invest into. I'll touch on a few that you've got to be very wary of. So it's pretty much, I wouldn't say open slather, but if it's sensible, you can do it. Two rules that you must keep in mind at all times, and if you follow those rules, you can't go too far wrong. The sole purpose test, which I'll come to in a second, and following the investment strategy and objectives that you yourself have set for your fund. So you can change them, so that's not really a big deal, but if you've said, I'm going to invest 100% into shares and leave it all sitting in cash in a bank account somewhere, the tax office can come back and say, look, you're just not doing the right thing. This is poorly managed fund. There are some investment restrictions. So they're not many, but if you get them wrong, you'll come into a lot of trouble. Primarily loans or financial assistance to yourself as a member of the fund, other members of the fund, family members, or other associates. So an associate, pretty much just think of it in terms of your family. So lending it to your son or daughter cannot be done. Lending it to yourself cannot be done. Borrowing, there's special rules about that. A super fund can borrow to invest, and I've got a bit coming up a bit later on that I'll go into that in a little bit more detail. So it can be done, but you've got to be very careful about how you do it and what you're doing it for. We mentioned in-specie transfers, so moving shares or property into your super fund. They are the only two things that you can move into your super fund. If you already own it and it's not a listed share or it's not business property, so commercial premises or farmland, you can't do it. And whenever you buy or sell anything, it's supposed to be done on an arm's length basis. So as if you're buying it from a willing seller, or if you're selling it out of the super fund, you're selling it to someone other than yourself. So you can't just rig the figures to give you the event that you're looking for. It's supposed to be done at market value and an arm's length basis. I've just made a tip there. Avoid collectibles. You can actually have collectibles in superannuation funds, and by that I mean vintage cars, Van Gogh paintings, stamp collections, those type of things that you might like to look at on your wall and enjoy, or scoot around on the way to church in the vintage Rolls Royce or whatever it might be. You can have them, but you've got to be so careful that you don't fall foul of the tax office and their rules around that. They've recently tightened those rules and made it a lot more difficult. Pretty much, if you enjoy it, you can't do it. So if you've got that Van Gogh painting, stick it in a safe somewhere and never look at it. Put it in a museum somewhere and let them hire it from you or something. But if it's on your wall in your living room and you're sitting there watching the TV and glancing up at the Van Gogh painting, you're in trouble already. Now, I promised to come back to the boring old sole purpose test, but if you keep this one in mind, you can't get into too much trouble. Basically, the sole purpose says that the super fund must be set up for the sole purpose of paying members a retirement benefit once they're done. If they're not retired but over 65, that's fine. Or if they're deceased. And I'll throw total and permanent disability into that as well. So if I mentioned, as I mentioned, the Van Gogh painting, if you're enjoying it now, you haven't met the sole purpose test because you're not putting it aside purely for one of those three reasons. So a couple of little examples there. Sorry, Bob, holiday house is out, mate. Holiday houses, beach houses were and probably still are to some extent something that we'd all like to get into the super fund. Don't worry, we promise to pay a commercial rent when we use it. That's fine, except that the tax office still says, no, you can't do it. You might even pay more than commercial rent and they'll still say, no, you can't do it, because you are enjoying something that belongs to the super fund that is there for your future retirement. The tax office are getting quite cunning about picking up on these things. Postcodes, they're a bit of a giveaway. 5275's Kingston, I think, 5276 Robedean, does that sound right? Yep, it's easy for the tax office to determine that that postcode sits inside that super fund. Maybe we better have a look. Cindy and a golf membership, these go back to famous superannuation cases which are really boring, but there was a scheme going a while there where you could pay a membership fee that included certain rights that gave you the ability to play golf whenever you liked on golf courses, and so everyone thought that was a great idea, except of course you're out playing golf and your super fund's effectively paid for it. So again, definitely out. You cannot do that sort of thing. So keep in mind, if you're smiling as you do it, you're probably in trouble. Investment strategy. A super fund, or the trustees of the super fund, are required to write down what they believe the super fund should be investing in, what its target is, what it's trying to achieve. It has to be written. It doesn't have to say I'm going to buy BHP shares, but it should say I'm going to buy Australian shares. The more detailed it is, probably the better, but the more detail it is, the more trouble you get yourself into as well. So generally we will do, if you haven't written it down yourself and are happy with it, from time to time we will send you one out saying this is your investment strategy, please sign here. So we'll do that retrospectively based on what's in your superannuation fund to try and keep you out of trouble. But yeah, it does need to be written down. Sometimes you can get yourself tangled up into it, so getting some advice isn't a bad idea. Borrowing, I mentioned that super funds can now borrow. For a while there they were prohibited from borrowing, but probably thank companies like Telstra for that. They launched their T1s, T2s and T3s instalment warrants where you paid a couple of bucks up front, they gave you the shares, got some dividends, and then a bit later you paid the balance. If you're in T1s, you're laughing still. T2s and T3s, you probably lost some money, but anyway, they did open the door for the government to allow super funds to borrow. They put some pretty strict rules around it, so you can't go willy-nilly just borrowing money and investing in whatever you like. You're pretty much restricted to property and shares, although borrowing to buy shares, personally I think is a bit risky, so I'm not saying you should. It's a lot easier to go to the bank and borrow for property inside a super fund than it is in shares, although there are ways to do that if you desperately wanted to. One of the things that stops people borrowing money in the first place for the super fund are the costs. You can't, although you might have a self-managed super fund, it doesn't borrow the money directly. You need to set up another little entity that sits off to one side called Bare Trust. Most banks will insist that that has a company as its trustee. There's documentation around that as well. So you're probably looking at least a couple of grand just to set up the structure you need to go to the bank to then borrow the money. Banks also have a, I don't think we've got any bankers here, but so I won't be too unkind just in case. But each bank has a slightly different view about how they go about lending the money in the first place. Generally they charge higher establishment fees. The excuse that they'll give is that they need to peruse your documentation from a legal point of view. Bank talk for charging more money just because they can. The margin that they have on their interest rate tends to be slightly higher than if you were just borrowing it personally. They have good reasons for that from their point of view, not sure about mine, but anyway. Limited recourse, that second point under the bank views bit. The only asset they can take as security is the one that you're borrowing to purchase. So if you're borrowing to buy a house, that is their security. They can't stitch you up as well or other assets of the fund up as well. They may give them a personal guarantee or something, but yeah, that's only as good as they're prepared to push it in the law courts. So from their point of view, they don't have as much security as they would like. So to be safe, they will charge you a bit higher interest rate and LVR, loan to value ratio, something like that. How much they'll lend against. If it's residential, 60 or 70% usually cuts it out. If you're borrowing in your own name, you can probably borrow up to 95% of the property you're purchasing. So they'll leave themselves a much greater margin of safety in that arrangement in the first place. So yes, you can borrow, but in conclusion, you wouldn't do it for 50 grand, you probably wouldn't do it for 200 grand because the costs are going to prohibit you doing that. If you're going to borrow, it needs to be for a reasonable size investment, or the dollars just don't stack up and you're better off finding another way of funding it. After I've scared you with a lot of these things, there's nothing to stop US trustees going out and getting as much or as little advice as you would like. There are some pretty key advisors out there and they're listed in the white boxes. 5 of those Murray & Ankerville can provide you with. Auditing, the accountant, the administration, stockbroking and the financial advice. Amy's here from Wesley's, legal advice. But the bottom line is that US trustees are in control of the fund and ultimately you're the people that sign the little dotted line to say yes we want to do this or no we're not going to do that. So you must be prepared to take that responsibility.